Is mortgage a scam or just a clever debt trap? Mortgages are either your golden ticket to home ownership or a fundamental trap dressed up as a dream. But here in the UK, especially in 2025, is taking mortgage still worth it? Stick around, I will show you how one UK homeowner shaved off over £25,000 from their mortgage with just one small monthly tweak. Let's begin by discussing what mortgage is. A mortgage is a loan you use to buy a home secured against a property. You pay it back on a monthly basis with interest, and averagely it takes between 25 to 35 years. Just think of it like renting from the bank until it's fully paid off. They own more of your home than you do. For example, let's say your dream home costs £250,000. You put down a 10% deposit, that is around, let's say, it's £25,000, and borrow the remaining £225,000. The borrowed amount is your mortgage. Let me quickly share some types of mortgages. We have the fixed rate, we have the tracker, and we have the interest only. For the fixed rate, it's a stable payment for a set period of years. For the tracker, it moves with the Bank of England baseline rates over the years. For interest only interest is paid in full at the end of the term. But just because the bank approves doesn't mean it's a good idea. Why do people think mortgages are a scam? Let's take an instance. Sarah bought a £250,000 flat in 2016. 8 years later, after paying religiously, she has only chipped away about £12,000 from the loan. You see, that's the power of interest. Interest is actually the silent cost. Let's discuss remortgaging. Remortgaging means switching your deal. It could be with your current lender or a new one. If done right, it saves thousands, but when it goes wrong, you are resetting the clock. Extending your term may reduce monthly payment, but you would pay more on the long term. For example, if I'm going for a mortgage and I decided that, okay, I want this mortgage to run for, let's say, 35 years. On a monthly basis, I'm going to be paying less, but on the long run, I'm going to pay more compared to someone that is going for a deal of, let's say, 30 years or 25, etc. It's best you start hunting for a deal 6 months before your current fixed rate ends. Don't just ask your bank. Speak to independent broker so that you can get the best deal out there. For example, Sarah started on a 5% fixed rate. If she remortgaged to a 4.2% deal, she could reduce her monthly payment and save around 8,000 to 10,000 pounds in interest over the next 10 years. This is really the power and strength of remortgaging. Come to think of it, is remortgaging a hidden saving weapon? I'll quickly discuss overpayment. Overpayment is one of the most powerful and underrated move for most homeowners. Overpaying just £100 per month on a 250,000 mortgage could cut off 5 years and save you about 25,000 plus in interest. Although most lender allows 10% overpayment annually with no penalty. Kindly comment overpay if you've done it or want to start. If you have been watching up to this point and you're not yet subscribed to my page, guys, what are you waiting for? Kindly hit the subscribe button. Having discussed all of this so far, some of us will be wondering why some still choose mortgages. Here are some of the reasons why lots of people still opt for mortgages. One, ownership and equity. You are gradually owning more and can remortgage with leverage. Advantage. Two, property appreciation. Property value often increased over time. Lower rate versus credit. Mortgage interest is usually cheaper than other credit out there. When compared to credit card, for example, for mortgage, you're looking at the range of 4% to 5, 6%, whereas for credit card, you're looking at 25, whooping 25%. So the fourth reason why people go for mortgages is the long-term planning. You can lock you can lock in interest for, let's say, 2 to 10 years, unlike rents that usually fluctuates. Having discussed some of the reasons why people go for mortgages, we need to understand that every reward comes with risk. So now I'm going to quickly share some of the risks with mortgages. One is negative equity. And negative equity happens when your home value fall below your loan. Let's say, for example, you have a mortgage running for, let's say, £250,000, and over time, the value of your property drop below that amount. Let's say 240 or 230. You can say negative equity as setting. The second one is repossession. When you miss payment, there's a high chances that you're going to lose your deposit and as well as lose the property. The third point is rate hike. For example, you start a mortgage at a fixed rate, let's say 4.2% or 4.5%, and at the end of that fixed period, you're unable to secure a good deal. Probably the deal you're now getting is £5, 5.5 to 6.0 rate. What it means is automatically you're going to be paying more because the rate has increased. So, having discussed some of these risks, let's discuss how do we mitigate some of this risk. You can reduce this risk through various ways. One, overpayment whenever it's possible. Two, build a 3 to 6 month emergency fund that can support you should in case anything changes. Don't stretch beyond 35% of your income when going for a mortgage. For example, if you're going for a mortgage, what you will be repaying shouldn't exceed 35% of your income on a monthly basis compared to what you're going to be paying monthly. Um, Shop for new deal early. Just like I shared, if you're on a fixed rate, as early as 6 months before it ends, you start looking out for new rates. Don't just focus on the current lender, but engage a broker to have a wider search for better deal. Then, of course, keep your credit score strong for better rates. Mortgages aren't good or bad. It depends on your goal and financial discipline. It's smart if you lock in a low rate, have a long-term plans, and overpay strategically. But on the other hand, it's risky if you live paycheck to paycheck, if you plan to relocate soon, and you don't understand the fine print on the paper for the mortgage, meaning I'm referring to the contract document. You can win at the mortgage game, but only if you play it smart. And it's not just about owning a home, it's about understanding the principle. All this while, we've been discussing mortgages, and I just want to quickly discuss why renting work for some people. Number one, renting comes with a lot of flexibility. You can easily move cities without strings. Low upfront costs. There's no massive deposit required. Imagine you're going to do a mortgage or buy a home. you'll be thinking of a deposit of, let's say, 25,000, 30,000, 50,000, depending on the value of the property. No maintenance. If you're in a rented house, the boiler got broken, it's not on your bill. You simply reach out to the landlord to have that sorted. Then the fourth reason is opportunity cost. Here you can save up, have capital to do businesses or invest in other stuff. So for my own personal reflection, is mortgage a scam? For me, if you understand the terms, build equity and manage the interest, it's powerful. But if you value flexibility and hate upfront costs, renting might be your peace plan. So if you're thinking, should I go for mortgage or should I just continue doing the renting option? What should come to your mind is, ask yourself this question: am I financially stable for the next 5 years? Do I understand how interest works? Do I want ownership or flexibility? Buy or rent? What's right for you? Kindly drop your response in the comments. Buying a home is emotional, I get it, but financial literacy is your peace of mind. This video could literally save someone thousands. So if you found it helpful, like, comment, and share your thoughts. And finally, please subscribe for more investment, career, and finance tips. Thank you for watching and see you in my next video.